But the reason it's important is it means that it's no longer, as a bank, if you're holding gold and you're holding it through an ETF or you're holding it in custody in another country, that's no good. That won't count. You've got to have the gold in your physical possession. So unallocated gold, that's gold where the bank just holds a claim, or paper gold, or doesn't have it in its physical possession, is going to be treated much less favorably than gold which is in the bank's physical possession. So what this does, it strengthens the market for physical gold when it's implemented, and it weakens the market for paper gold.
Friday, April 18th, 2025, Maneco 64, home of alternative economics and contrarian views. I'd just like to say happy Good Friday, happy Easter to everyone, and good morning, Clive.
Good morning to you, Mario.
Yeah, Clive, you probably heard the argument before that gold is useless because you can't eat it. The counter argument, of course, is that you can't eat Swiss franc notes, you can't eat pound notes or coins either, but that you can exchange them for food. But I found out that you can also eat gold. And yesterday, my wife and I went out for lunch with Eric Young. He's visiting London. And he brought me this, Clive, from Lisbon in Portugal. So it says Ouro Português, which is Portuguese gold, and it's sardines, boneless sardines in virgin olive oil, and it's got flakes of gold in it.
Yeah.
And you can see here in the back it says gold flakes. So Eric was saying this is people buy this as a souvenir. They don't really open and eat it. And it costs him about, I think, 30 euros. So, and I said to him, what if the gold in there becomes worth more than 30 euros? Is there an arbitrage opportunity where you buy thousands of these, sieve the gold out, eat the sardines, and make a profit? Anyway, just thought I'd show this. And the other thing I like to tell the viewers here in the UK, and this pertains to gold investments. Some of you have been contacting gold investments, and Oliver said the best way to contact them is not via the contact function on the website, but to email him directly. His email is oliver@goldinvestments.co.uk. And he also said not to forget to use my promo code, Maneco64, because that gives you a 0.5% discount off the listed price. So yeah, Clive, what do you think about the gold flake sardines?
Well, out in Asia, I've often seen, in Hong Kong in particular, I've seen foods which are offered for sale which have gold flakes in them. And whether it does anything medically, I don't think so. But it's a thing, to have gold food with gold flakes in it. Of course, it costs a lot more. And I'd hate to think what's going to happen to you, Mario, if you eat it and then the price of gold goes up, because you're going to be a wanted man.
Yeah, and I guess it dispels the notion as well that you can't eat gold, right, Clive? But apart,
Well, we can in Switzerland. We make our money of gold. I mean, that's how they keep the money supply in check. I mean, anyone who doesn't know that your Swiss money is made of chocolate. I can't show you one of the Swiss
yeah,
coins at the moment, but that's the answer to excessive money supply. Make it in chocolate. Obviously, our chocolate's covered with gold foil. It's not real gold, though. But if it's made of chocolate, of course, then you can keep the money supply in check because people will eat it.
yeah. Clive, there's quite a bit to talk about today, and the markets are closed, so we're not going to look at live prices. But you wrote something about Basel III and the gold market, so maybe we can start with that. And I'm going to share here what you wrote. And we can, yeah, you can talk about it as we go along. And yeah,
So, yeah, first of all, Basel III is a set of banking, I'm going to call them regulations, but in fact, realistically speaking, they're guidelines which are coming out or came out some time ago from the Bank for International Settlements. It's actually coming out from a subdivision of the Bank for International Settlements. But basically, when these Basel regulations are brought out, the vast majority of Western countries tend to follow them. Now, the Basel III recommendations have something very important in there. They make gold into what's called a tier one asset. That means that it ranks at the highest possible level for the purposes of bank reserves. But to qualify, you have to have the physical gold and in your possession, and provably so. So banks which hold physical gold bars are allowed to count that as high quality as cash. Now, it's not really as high quality. We know cash is as high quality as gold, but it's the highest possible quality for the purpose of calculating your reserves. So if you're going to have reserves in a bank and you don't want to have it all in treasuries or time deposits, whatever, you can have gold bars and they'll count at an equal ranking. So why is this important? It's likely that in the coming 6 months to year, most countries around the world, including Switzerland, USA, Europe, Japan, and others, will implement the Basel III regulations, basically meaning that banks can now count the gold that they got in their physical possession as a tier one asset instead of an asset which is much further down the line and worth less. So if it wasn't a tier one, you didn't need more of whatever you got. But the reason it's important is it means that it's no longer, as a bank, if you're holding gold and you're holding it through an ETF or you're holding it in custody in another country, that's no good. That won't count. You've got to have the gold in your physical possession. So unallocated gold, that's gold where the bank just holds a claim, or paper gold, or doesn't have it in its physical possession, is going to be treated much less favorably than gold which is in the bank's physical possession. So what this does, it strengthens the market for physical gold when it's implemented, and it weakens the market for paper gold. So what might be going on already? It could be we've seen a lot of movements of gold around the world, and central banks are bringing the gold home. We've had several central banks in the last few years start to bring their gold back home, and we're seeing some large movements of gold out of London into New York. What could be going on is that banks are preparing themselves for these Basel III regulations by making sure that when they are implemented by their local governments, that they actually have the gold in their possession. And what might happen, and I'm just speculating here, it could well be that down the line, the physical gold becomes so important that it has a different price from the paper gold. In other words, it'll be, I mean, factually, it is more valuable than paper gold, but you might actually find that spot gold and physical gold in possession is worth more than, say, gold in an ETF or gold as a promise from some custodian somewhere.
Yeah, and even like a Comex futures contract, if let's say if you're trading the April contract, which is a spot month, which you can take delivery, that means that the spot price for physical gold will be higher than the April contract. The other thing about Basel III, Clive, I think, yeah, allocated gold, which is physical gold in your possession, that will have zero risk. So it's 100%. You can use that to calculate, I think, the capital adequacy rates of banks, so it's really important. And unallocated gold, there's a 15, there's 15% discount. So there is a risk in unallocated gold, Clive. But I remember that in 2022, if I'm not mistaken, a lot of the European banks implemented this Basel III recommendation about gold. Is that true? And the US didn't?
The Basel III recommendations came out some years ago, but it takes time for each government to make it put it into their legislation. It doesn't mean to say that banks can't choose to follow the rules ahead of time, and many banks probably are doing that. But I think there's only a couple. It might be Switzerland and Japan. I'm not sure. I think there's only a couple of countries which have already passed it into the legislation. USA, they're talking about it happening this summer, and I think the rest of Europe, it's not yet legislation, if I'm not mistaken,
So
but
I,
it's
I
coming.
guess, yeah, there's been speculation in the US is going to be from the beginning of July. Yeah, that could be one of the reasons why a lot of physical gold is going into the US. And I mean, I would say when Europe does it as well, or the Eurozone, it could be even more explosive for the price of gold.
It will
And
be. It'll bring the gold home. Banks will want to say they will stop lending out their gold because lent out gold isn't worth nearly as much as gold that you've got physically in your possession.
yeah, and Clive, I guess this will probably be the end of, not the end, but the Comex and LBMA paper markets. The people who have short positions in paper gold, they're going to have to cover, and I think this is why we're seeing gold being so strong of late. And I think even though there's a lot of people out there calling for a top, I'm not too sure we've seen a significant top yet. I mean, even if you look at this chart, Clive, which is a quarterly chart, we had a correction after the November election in the US right here, but it doesn't even look like a correction. And what's your view on that?
Well, at the moment, as far as gold is concerned, obviously we've got the things like Basel III going on, but I think the other thing which is going on is a general malaise about the stock markets. Tariffs are coming in some way, shape, or form, and of course we are flip-flopping on a day-by-day basis. But at the end of the day, if tariffs exist, it means less profit for many, many companies all around the world. And less profits could mean, well, will mean that analysts will be paring back their forecasts. And as they pare back their forecasts, and as companies come out with their annual reports now, which is we're now in the reporting season, there's going to be following these annual reports what's called the earnings call, where the directors talk to the analysts. And I think a lot of companies will say we are suspending our forecast, our profit forecast for next year, or some companies will say we're lowering it because of what's happening with the with the tariffs. Now, the result of that is analysts will pare back their forecasts and reduce their target prices. And it's quite likely that as people see this happening to their personal shares, oh my goodness, such and such Goldman Sachs have reduced the price on my favorite share, the target price. I better sell it before everybody else does. So we might get into a bit of a selling spiral. I mean, we're already seeing that the markets are off 10%, and I think that could go further. I think it will go further. I'm sorry, not saying could go further. I think it will. And of course, the question is, where does money go when people sell their stocks? Now, the obvious place to go, looking at what's happening to the gold price, is in fact gold in some way, shape, or form. And you only need a tiny bit of the stock market to go into gold, and you've absorbed the entirety of this year's production. I've got a few numbers here from an article I did on LinkedIn the other day. The annual gold production is 0.21% of the global stock market. So if you had 1% of the global stock market saying we want 1% allocation to gold, that would absorb the next 5 years' gold production and some. So you can see how a very, very small allocation by international investors from stock market to gold will absorb all the gold which is coming out of the ground for a very long time. Of course, there'll be some above ground gold which gets sold too. People will supply the market, but they'll only supply the market at higher prices. So I think that what might be going on now, we've got a falling stock market. We're going to have a falling stock market, in my opinion, with the results which are coming out, and people are going to be looking for somewhere to go. And the obvious place to go, or one of the obvious places to go, is gold. Of course, the other traditional place to go would be treasury bonds, but we're not really seeing much of a rise in those on that. They're really they're not going up. The
Yeah.
yields are rising, which means they're going down more than anything else.
Yeah, talking about treasuries, we're going to look at an article on Bloomberg about treasuries, which is interesting. But before that, I'd like to make a couple of points, Clive. You spoke about the tariffs and how they uh, make profits uncertain for big corporations. And I mean, that's one thing I was thinking about last year when Trump was saying he was gonna, if he was elected again, that he would impose tariffs. And I thought the biggest losers are going to be people like Apple, the big U.S. corporations, because you look at the products from all the big American corporations. I mean, I've got here a tennis ball. I don't play tennis anymore, but I bought some tennis balls to play with Rudy and also to do some exercise with my feet. And of course, the tennis ball, the Wilson is an American company, but it's not made in the US. So, yeah, there's a lot for corporations it's not that simple to reshore everything and start producing cheaply in the US. And the second point, Clive, about I think, yeah, you're speaking about the stock market. You wrote something here about the volatility of the stock market, and I'll bring it back up. I had it on. So could you talk about that? And I thought about this the other day as well because a couple of weeks ago, I think the Nasdaq was up 12% in the day. It doesn't make sense.
Yeah, I mean the craziness of the stock market that we are seeing in recent years. I mean, last week or the week before was a classic example of that. We get a tweet from Mr. Trump, and the stock I can't remember what it was now, but the stock market soared by 8% or $20 trillion on the back of a tweet. Now that's a very new world where rumors and innuendos and social media are moving the stock markets by huge amounts. I mean, in the old world, and I go back to when I started investing, if you wanted to know if a company was a good investment, you'd go down. And in my case, I'd go down to the Institute of no, the London Library. I think it was called the Institute of Bankers Library. It might have been, but the London Library, and get out what's called the Excel cards. I look through the Excel cards and find the profits and losses of the companies, and eventually I'd find a company I liked, and then I might go and get the annual report, which they also stored in the library, and then I'd buy it, and then you wouldn't change that company probably for years. You'd hang on to
Yeah.
it.
I remember the Excel cards, Clive.
Yeah, that was before we had any online stuff. We're talking about the 1970s here. Now today, markets are moving not only because there's humans trying to buy things, but because the entire market is occupied by bots who can read your mind. And when I say they read your mind, they're looking at Facebook and Twitter and all kinds of things like that, and every bot is trying to race you to the market. They're trying to race each other to the market. So when things move, they move very, very rapidly. And the prices, because people can move in and out of stocks, the prices have become very disconnected with the underlying value. And that's why we're seeing today relatively high multiples. Now, I'm not saying the highest in history, certainly not, but they are unusually high on the tech stocks, especially. We're seeing relatively high multiples caused by this army of investors who don't really care what the value of what they're buying. All they care is, can they beat everybody else in the market to sell quicker and buy quicker? Now, I'm not saying that's good or bad. It is just the way it's become. But share prices have climbed to levels which are beyond what a sensible businessman would pay for the entire company.
Yeah, you say as well, Clive, that this is a symptom of the whole monetary system, how it's just endless paper promises, and that yeah, it's not real wealth. And you even say that the emperor has no clothes. So could you
Yeah. So,
explain that
yeah.
concept?
So why are asset prices going up? And this includes gold, of course, and property prices and stock market. But the money's going to the stock market, or has been up until now. Why? Well, the governments of the world have been getting poorer. In other words, they borrow money because they have a budget deficit. They borrow money and spend that money. So as they spend that money, someone, maybe someone else, not you, but someone, or maybe everybody, but somebody somewhere is getting richer. And as those people who get that government money, wherever it flows to, get richer, they're investing it in all kinds of things. And of course, the stock market has been where it's going. They're not buying more pizzas or anything like that. So the government is getting poorer, everyone else is getting richer. And that money finds its way and has been finding its way into the stock market. The fortunes flow straight into the stock market, inflating prices far beyond what makes sense to a businessman if they were buying the entire business. But the problem with this is it's not real wealth which is holding up these prices, because this money which the government has created, the government has now borrowed money, they owe the money. We're talking about treasury bonds here. These treasury bonds, in the long run, they're never going to be repaid because they cannot be repaid. There is no possible way on the planet that any Western country can repay its debt. We've gone past the point of no return. So that debt can never get repaid. So what we have are asset prices around the world being held up on the promise that the government will always be able to borrow from Peter to pay Paul. In other words, when they have to repay your debt, they'll repay it by borrowing from somebody else. And they're trusting that that Paul will be there to borrow from. Borrow from Peter. They're trusting that Peter will be there so they can repay Paul. And they have a plan B. If that doesn't work, well, we've got a lovely central bank who can be leaned on heavily to print as much money as we need if it gets to the problem, and we'll pay you from all that newly printed money, which obviously means you're getting repaid in devalued dollars, devalued pounds, devalued euros, and
That's
so forth.
the way to pay off the debt, and the bag holders are the creditors, and that's why you've warned, and I've warned in the last few years that having government bonds is a really bad idea. But unfortunately, a lot of the regulators they think that government bonds are the safest place around, and they force pension funds and others to hold government bonds, not gold, of course. And talking about regulators, Clive, I saw this article yesterday on Bloomberg, and I'm going to bring it up. And I have to think someone on X posted it. And then I looked for it on Bloomberg, and it says Europe's financial watchdogs question Treasury's haven status. And that's U.S. Treasuries. And I think that's pretty significant. And they are talking about the fact that there's a lot of volatility in Treasuries. And the other thing, Clive, you've probably heard about this. Janet Yellen, when she was Secretary of the Treasury, and even before her, there's a lot of talk about the problem with liquidity in the Treasury market. That's been a problem since 2015. Liquidity means that you can easily buy and sell any Treasury you want. It used to be like that when I started out, but I think there isn't that the liquidity is draining because there's so much treasuries out there, and there's not enough people demand or supply. There's not enough demand, and the market makers, which are the banks, they've been forced to not hold as much treasuries as this statutory leverage ratio, which actually the Trump administration wants to do without. But another reason why it looks like gold is the new safe haven. So could you talk about that, and whether, because it says in this article that people are buying gold and German bonds, German government bonds, and even euros. Do you see those as safe haven? I don't see, I see gold as safe haven.
Well, there was a commentary, I forget from the USA, about whether China would be weaponizing its dollar treasuries by selling them. And I think, I can't remember who it was, maybe it was Basel. But basically they said, or maybe it was I don't know who it was now, but they said basically there's no chance China is not going to do that. They're not going to dump the treasuries. Well, maybe. But what with everything that's going on, I think that governments around the world are probably getting the feeling that if they are allies of the United States, if they want to do a deal with the States on the tariffs, they're going to be leaned on to be holding treasuries and hanging on to them, and they're going to be leaned on maybe to even buy more. So, what do you do if you feel that's coming? Well, if I felt that someone was going to lean on me to buy something and I already own some of it, I'd probably sell a bit of it so that I can then make the right move and buy it if I'm forced to do so. So my feeling is that the pressure is on from for central banks and governments around the world to rearrange their reserves so that they're not increasing treasuries and maybe reducing them a bit in favor of alternative assets. That would include gold and euro, dollar bonds in euros and pounds and Swiss francs and so forth, and Japanese yen, so that if it comes to a push to a shove, and I find I'm literally being told we're not going to give you a tariff deal unless you increase your holding of treasuries, at least I've got something I can turn back into treasuries if I find that that's the way I'm going to go. Now, of course, some countries will play hardball and say, please don't tell us what to do. And the response to that might be, well, if you don't do what you're told, we'll increase the tariffs on you. You can call it bully boy tactics or whatever you like, but I think we have to accept the reality of the world that America is a very, very tough trading partner now, and they're waving the sabers in the air, and basically they've said, we want to see if someone wants to do a deal on the tariffs, tell us what you're offering, we'll consider it.
And talking,
So
oh, sorry, yeah, go ahead.
yeah, well, so we'll see where that goes. But I think one of the things they're going to expect is that countries do hold treasuries and don't get rid of them.
Yeah, and you spoke about the bully boy tactics and the trade wars and tariffs. It seems to be backfiring, even though I don't think China is a huge client of the US in terms of LNG, but it says here China stops buying liquefied gas from the US. And I've read the article. I highlighted here this part. It says there will be long-term consequences, says Anne-Sophie Corbeau, a gas specialist at Columbia University Center on Global Energy. And she says, and I thought this was interesting. She said, I do not think Chinese LNG importers will ever contract any new US LNG. So, as you see here, last year only 6% of China's LNG came from the US, but it's down from 11. I think what this is going to do, it's a little bit like the when they imposed sanctions on Russia, they just found an alternative. And the Chinese are already talking with the Russians who provide them with gas from Siberia. They're talking about a new pipeline called Power Siberia 2. And there's loads of other countries, Clive, in Asia who also are yeah, they're moving towards Russia, and I think Dubai or Qatar, sorry, they produce a lot of gas. So I think, yeah, this could be America be shooting itself in the foot in terms of its energy exports. And just wanted to move on to a next topic, Clive. I've spoken about this a couple of times this year because, as you know, I like history. And back in the 1830s, Andrew Jackson, the president, he was in a war. They called it the Bank War against Nicholas Biddle, who was the head of the Second Bank of the United States. He didn't like central bankers, Andrew Jackson, and then he did not renew the charter in 1836, I think. So the U.S. didn't have a central bank from 1836 to 1913. But now I spoke in February and I think in March that we could have a second bank war brewing. It could be a little different in that maybe President Trump is not really trying to abolish the Fed, which I think would be good, but we can't get everything we want. But he might be diluting the Fed's independence. And why is that? Well, I'm going to bring up a couple of articles, Clive, and then I'm going to let you chime in. Just wanted to. So this came out here yesterday. Donald Trump ratchets up pressure on Fed Chair Jay Powell to cut rates. And then we saw this, and I'll play this. This is quite interesting, Clive. Don't know if you've heard this.
He says he won't leave, even if you ask him to.
Oh, he'll leave. If I ask him to, he'll be out of there. But
Do you like?
I don't think he's, I don't think he's doing the job. He's too late, always too late, a little slow, and I'm not happy with him. I let him know it, and if I want him out, he'll be out of there real fast, believe me.
So, Clive, and the viewers, don't get me wrong, I don't like central banks or Jay Powell, but the perception in the markets, mainstream markets, is that if the president dilutes the independence, so to speak, of the Fed. And I don't really think the Fed is that independent. I mean, they've been printing to help the government for years. But be as it may, it's a little bit like in the 70s. I think the Fed wasn't that independent, and we saw what happened.
Well, there's a lot of things in there. First of all, it's a question of what Jay Powell is going to do. Is he going to stay on, or is he going to throw in the towel and say, nothing to do with what the president said, but I'm feeling a bit old or out of it, or I've got an illness and I think I have to retire, and he might go gracefully, or Mr. Trump might, in some way, shape, or form, fire him. And I don't know. I think that's legally not possible, but who knows what might happen. Or he might say, you know what? I don't take orders from the president. I do as I please, and I'm going to stay here until the end of my term. I don't know how you would act in such circumstances, but one of the things I've kind of learned throughout it goes throughout all of history, not in my lifetime, is it doesn't usually work out well if you are the enemy of those who are in power. So it might well be the graceful thing for him to back out, not saying I mean, he certainly won't say I'm doing what Mr. Trump wants. That would be too much. But I think he might just decide that I'll go while I still can, and I won't face worse consequences down the line, or I might get some sort of favors if I do it now. That's so. I'm betting. I'm giving it a slightly more than 50% chance that Mr. Powell is gone by the end of this year. Now, of course, it might be a lot sooner than that, given what's going on. But I think if that does happen, the markets are going to take fright, and I think we're going to have the mother of all stock market crashes if that happens. And the bond market is not going to do well either.
And what do you think is going to happen to gold and also silver?
Well, the whole point, if Powell goes, it means that Mr. Trump will put in somebody who is pro-Trump, of course, and we know what Mr. Trump would like, and that is much lower interest rates immediately. And I'm not saying that's right or wrong, but that's what he's asking for. And the market would see that as a cave-in by the central bank, a weaker policy. It would weaken the dollar. And of course, that would be very good for the gold price, because people are going to say we're back to quantitative easing, we're back to printing money. Obviously, printing money makes rich people richer, because they own hard assets like gold and like equities and like property and so forth. So that's how the market will perceive Powell going. They'll say he's gone. Now the Federal Reserve's effectively under the control of the president. The president effectively wants to print print infinite amounts of money to boost the economy. In a way, one could call it a good thing temporarily, but at the same time, it also boosts asset prices significantly, and we'll get the mother all rallies in gold. We'll get the mother all rallies in the stock market. But as a first step, we're going to get panic, because we will say, I don't know what's going on, and there'll be a crash in the stock market. So I think we'll have another one of these wild days where it goes down, and then Trump says, well, my replacement is this person, and then up it will go again.
Yeah, it sounds really counterintuitive if you look at what Trump and Besant have said, that they want to like rein in Wall Street, that it's Main Street's time now to rebalance the wealth inequality, but by being how can I say so against Powell and threatening to bring someone in that would inflate so much, you're actually going to make it worse for the people that you're claiming that you want to help. Because, like you said, it's only the very wealthy that are going to do really well. The general public, the bottom 50%, their cost of living is going to rise even more. But yeah, we spoke about silver. You just talked about silver a little bit, and I want to bring this chart, Clive, because the gold silver ratio is really at above 100, and people are really frustrated as to why silver hasn't even broken like 30. They're frustrated that it's not above 50, let alone even 35. So I brought this chart up here, but just your opinion on silver. Are you giving up on silver, or you think silver is just, and we've said this many times, is about to break out?
The way to play the game is to own both gold and silver. When silver does eventually break out, and my breakout price is more like 36. Most people are talking about $35, but I think it needs to be more definitive than that. But 36. I think once we're above 36, we'll move we'll move higher very, very fast, a lot higher. But you can't say when that's going to happen. But if you own both, you're well prepared because you've got one of your two assets rising a lot, and the other one, after all, silver has gone from $20 odd to $30 in the last year or two. Since when we started talking, Mario, silver even dipped below $20 a couple of times, and during that in the early 2 years ago. So it's already done not bad. It's having its pause now, and if you're a really short-term player, it's not where I'd be putting my money. But if you're a long-term player, you want to be owning it before it does this 10 or 20% move it's got to do to get above 35, 36, because once it's moving in that direction, you'll try and buy it, and you'll say, I should have bought it yesterday, I should have bought it last week, I should have bought it last month, because you'll have missed the boat. So that's what I say. I think don't be diversified, have some of each, and you'll catch it when it's ready.
Yeah, I can see why you're talking about 36 because what year was this? Back in 2011, 2012, after silver topped, it tried to come back, and 36 was a huge resistance. And I mean, we've broken this trend line here, this red one, and it looks quite important. And this actually shows how powerful silver is, even though it's frustrating at the moment. Because usually, Clive, when you get a first move up like that, and then you get consolidation, but you get lower highs and lower lows, like it forms a flag, and then it goes up. But this flag is like going up, which means there's a lot of, I think, pent up demand. And I think one of the reasons silver is not going higher is because the bankers, bullion bankers, are throwing a lot of paper at it to try to, because it's a smaller market, to try to control the gold price. Because if silver was going through 36, 40, 44, or 50 right now, gold would be racing even more, in my opinion.
I think for the benefit of your viewers who are not looking at the chart and they're listening to you in their car or whatever, I'll just describe what a flag pattern is. It's when you have a fairly strong rise, which we had, followed by a series of ups and downs, and those ups and downs are gradually getting smaller in size. So I want you to imagine the flag on a football field for the corner post, where it's a triangle flag. So it goes up, and then it starts to move to the far right-hand side of the triangle, with each up and down getting smaller and smaller. And from a chartist point of view, the question is whether that flag is sort of pointing upwards towards the sky or downwards towards the ground. And what you're showing here is the chart pattern seem to be pointing upwards towards the sky, which means that when the breakout does finally come out of that triangle, it can be very, very explosive upwards and can go very, very fast. Of course, that's chart theory on its own. You need something to back it up in terms of fundamentals. And we do have that, luckily. We have the knowledge that the demand for silver due to the electronics industry, is rising year after year after year. And the mines, we also have the knowledge that the mine supply has been going down. I think it's planned to go down again this year. So the mine supply is static, and the usage supply or demand is, particularly from the electronics industry, is rising rapidly. So we have, for some years, about 5 years now, we have this imbalance of more demand than supply, and that difference has been coming out of recycled silver. People are taking their gold bar, their silver bars back to the coin dealers, their coins back to the coin dealers, the knives and forks, the candlesticks, and they're having that sort of stuff melted down. And as that gets put back into the system, it fills the difference between what the mines can dig up and what the electronics and other industries can consume. But to incentivize that recycling, you need to have forever, especially as the gap is getting bigger, you need to have forever higher prices. So I think we do go higher on silver, but it's never going to go in a straight line, and we've seen that in the last 6 months, where it's been a real up and down yo-yo, and people have got very, very frustrated every time it's got up towards $35. Oh, it's about to break out, and then it plunges down. I mean, I'm as guilty as anybody of saying that. There were a couple of times where I said, it looks like it's going to do it, and it didn't. But it's coming.
Yeah, I mean, yeah, I think what you said there, have both gold and silver. And right now, yeah, like I have this app called Ounces, and I put the amount of gold I have in silver. And the percentage of the fiat value of the silver is like dropping quite quickly. But yeah, have both. The other thing I never do is sell my gold to buy silver. I just try to get rid of fiat and buy both. So Clive, with that, I'm gonna wish you yeah, a great long weekend. Not that it matters for us that much. Long weekends, we don't work for anyone. And yeah, we'll talk on Sunday for the live stream.
Yes.
Yeah.
Yes, we will. Happy Easter to you and everybody else, Mario.
Thank you for you too. Bye.